Hello, guys. Once again, welcome to my finance class. My name is Joseph Ejike Oji, and today our topic of discussion will be debt management ratios. Remember, we are working on ratio analysis, and we are almost finishing the different kind of ratios. Anyway, our topic of here today is debt management ratios that we call it the leverage ratios or financial leverage ratios. When you hear the word leverage, or the term leverage, it means a lot. I mean, in finance field, it has a lot to do with debt. You know, basically, it's about lean on debt to enhance the outcome of a deal. You know, anyway, now the debt management ratios basically what they do is to measure how much a company is leveraged, which means how much debt that the company use to finance their assets or operations. So now using debt to finance your operation have some advantages. I mean, if the debt or the what you owe is not too much. So if the debt is properly managed, it has a lot of advantages. For example, it has what we call a tax shield. Tax shield. It means that the more if you use leverage, it will reduce the amount of tax the company will pay, or what we call a taxable income. So when you reduce the taxable income, that means you pay less tax. However, if the leverage or debt is too much, it has bad effect. Uh, so too much debt hurts the profit or earnings. Uh, you know, Also, there are other advantages like constrained growth. If you have too much debt, that means you cannot borrow more money to do more projects that will add value to your company. Another one is that there are also too much debt scares away investors. Uh, and also, it can lead to loss of assets because your lenders might get angry with you and decided to liquidate your assets if you cannot meet up with the obligations. So these things I explained are a good indicator of how important these ratios, the debt management ratio, are when you want to evaluate a company. I use debt ratios because it tells me that just like on a personal level, if you have so much money that you're owing to, to people, I mean, you have so much debt, it will limit so many things that you can do. It will limit your life in so many ways. Same thing with the company. If you have so much debt, it will affect a lot of things, profits, and what they can do. So again, this tells us the importance of the debt management ratios. Now, there are two main categories of this type of ratio, actually three of them, um, which I'm going to explain in a few minutes. First, we have the debt ratio itself, or the leverage ratio. Then we have the time interest and ratio. And then, of course, we have the debt to equity ratio. Let us look at each of them one by one. Now, the debt ratio or leverage ratio is used to evaluate the debt levels of the company. Uh, so, in other words, it tells us how much the company's assets are financed with debt. Now, um, let's see a few examples. I'll look at the formula here. Now, all the information that we'll be using for these computations, like I always explain that comes from the company's financial statement. And for this particular lecture, we'll be using Walmart. And then we can also get other financial statements to compare Walmart with other companies with respect to the debt management ratios. Now, debt ratio is calculated by using a total debt by total assets, or I can call it note payable plus long-term bonds divided by total assets. We all know that what a bond is. A bond is a debt. We discuss it in elaborate form as soon as we finish with all the debt management ratio that we need for evaluating a company. Those of you who want to evaluate a company to see if it will be a good investment, I want you to put your ears to the ground, just like you did in the previous lectures. Now, then there's the debt to equity ratio. This one is total debt divided by total common equity. Now let us do the calculation for Walmart. Now for Walmart, we'll be using 2021 and 2020 data. So I'm going to share my screen with you here. Now let me get my pen and I hope you're ready to start work. Now the debt ratio formula, total debt divided by total assets. Okay. Now for Walmart, total debt. Now, okay. For total assets. Now let us look at this. Go to Excel. So we're using the balance sheet for this. Now, total debt for 2021 for Walmart equals, let's see the total liabilities here. Okay. Then for 2020, total liabilities is I'm gonna put it right here. Make sure you're seeing this. Okay. Right. Equals total debt, total liabilities is this. So it's right there. Now let's look at the total assets. You can see the total asset right here. So I'm gonna copy them and paste them here. Okay. So this is for 2020 and 2021. Now, let us calculate the debt ratio. Debt ratio. Okay. So it simply means whenever you are doing calculations in Excel, remember to put equal sign first to put the Excel on a ready mode. Total debt divided by total assets. Okay. And then you press the enter key, that gives you the debt ratio for Walmart. Remember, this is Walmart's balance sheet. So I'm going to highlight it. Okay, so you can see the answer right there. Now, usually I like to, usually we leave it in 2 decimal places. So I'm going to format this cell, and make it just 2 decimal places. Okay. Now, what does this tell us? In 2020 is 0.66, and 2021, which I've not finished yet, is 0.65. Excuse me, it went down a little bit. Excuse me. Now, so what is the implication? I'm going to show you how I explained it. It means that for Walmart in 2020, Walmart debt ratio is 0.65, which means that 65% of its assets was financed with debt in 2021. But in 2022, if you look at in 2020, when you look at the balance sheet, our answer it says 6.60. That means 66% of its assets was financed with debt. Okay. Now, so we can try this with other companies. I'm gonna put other companies in the same industry or similar industry. I'm gonna put Walmart here. Okay, which we have already calculated. I'm gonna use the current one answer we have here. Then we have the Walmart 2021. I'm gonna put it right here. Okay. Now let's try targets. Now we can use a company that is not in the same industry. Usually, when you invest in stock, you don't put your money in one industry. That is not a good way to diversify. So let me put company like McDonald's. Okay, and then one more company that will even make it even more so you can see how it varies across the which company have more debt with respect to their asset base. So I'm going to put one more company here. Suppose I put what's the name of this company that does electric vehicles? Tesla. Okay, Tesla. Let me put Tesla. Now I'm going to go bring up their financial statements, their balance sheets, and then put their information here so that we can calculate their debt ratio. So I will start with targets. So I'm going to take you to Yahoo Finance so we can get the information. We need finance.yahoo.com. Finance.yahoo.com. So for targets, I forgot the symbol, but I think I'm going to type it in. It will bring it up. Targets. Okay, Target Corporation is out. You can see right here. Make sure you're seeing all this. Excellent. For Target Corporation, see the financials here. And then I can pull out the balance sheet. And then targets. So I have total debt. Then total assets. Okay. Next, you can see from the balance sheet here, targets. By 2021, you can see that the total debt is everything is in millions. So 151,09. So you can see right here 15109 then 000. And total assets. You can see total assets right here. 248 and 000. Now, next company we are looking at is the we wanted to look at McDonald's Corporation. MCD is the trading symbol for McDonald's. Total debt and the total assets. McDonald's. So for the financials, from there we can get the balance sheet for the current year. Okay. You can see that the total debt for McDonald's will be, I think this income statement to get the balance sheet right there. See the extensive balance sheet right here. So total debt, you can see right here, total debt, 51, okay, 463, 200. And total assets, 52, 626, and 800. Now, the other company we chose is Tesla. Okay, Tesla. Well, it makes electric vehicles, a vehicle that doesn't use a petrol to operate. So we're looking at the Tesla total debt and total assets. Okay, so Tesla the balance sheet shows us that the total debt is as of which is 2020. Okay, they don't have 2020, 2021 data. So we just go with what we have. Okay. So we have total debt, which is 13 279 000. Total assets is total assets right here, 52 148 000. So this is now we can now put all this information. They will tell us which company have more debt than the other one. So you can see. Let's go back to our. Okay, let's go back to the Excel the spreadsheets and put this information, then calculate the. So the target will be 151 total debt 09000 total assets. So it changes to this to the scientific form. Don't worry about it. We're good. I can make it bigger than this if I just adjust this. See. So now total assets 51 248. Now McDonald's will be 51 463 200, and then total assets will be 52 626 800. I know some of you might be wondering why I'm doing it this way. I want to use real life companies so that you can see by yourself that evaluating a company is not really difficult. You can do it by yourself and decide which company to invest your money on. Okay, and always when you put your money in any stock investment, in any stock, hold it, at least have a holding period of at least 2 years, no matter what the market is doing. Within that 2 years, you can now see if the stock increase in value or not. Buying today and selling tomorrow, except if you have inside information, which is illegal to do. Otherwise, buying today and selling tomorrow is you lose a lot of money that way. Plus, at the end of the year, the IRS will come for your head, for tax liabilities. That because each time you owe, you make a gain, capital gain, you pay tax. Then, plus the transaction cost that you incur by buying today and selling tomorrow, buying in the morning and selling in the afternoon. So we add all this, you see that we are really losing. But if you have information that is reliable, or you can create your own inside information, which is what we are doing now, that this one is legal because you are creating your own inside information. But if you have let's say that a stockbroker called you and told you this stock or this company, they are developing a new medication and the stock is going to rise. Nobody knows about it. That is illegal. That is inside information. So unless you have that kind of information, that's the only way you can buy today, buy tomorrow, and sell the next day and make consistent return, good return. Other than that, the best approach is to value your company, buy it, and hold it for a while. Anyway, I think you get the point. Look at Tesla, 13 279 000. Then so we have this 52 148. Okay, 000. So let us. This is it is converting it to into scientific form. So let us take another form. Okay. Now our debt ratio, again, total debt divided by total assets. Assets. Okay. Now this is for Walmart. We have it already before, so we can now copy the formula and it calculate the rest. and then we highlight it, and then format the cell to make them to the smart places. Okay. All right. Now, I said that Walmart owes more than Target. You know, for every dollar of assets, or let's say 65% of all the assets owned by Walmart is financed by debt. Now, but for other companies here, for Target, it's only about 29% of their assets are financed with debt. For McDonald's, it's 98% of their assets are financed with debt. Tesla, 25%. So if you ask me to buy the stock of any of these out of these four companies, I'm going to choose Tesla and this Target and hold. Even if they're not popular, I'll just hold it. Based on the debt ratio. A different analyst might say, "Oh, I'm gonna if it is using profitability ratio." Might say, "Okay, McDonald's is better and Walmart are better." So that's why you see different analysts talking about different things about different companies. One analyst might say that this company is good. Another analyst might say that this company is not good because they are using different ratios to analyze a company. But the debt ratio is very important. I'm sure that you are enjoying the lecture so far. Now, another debt management ratio we'll be looking at is the one we call the debt to equity ratio. For that one, we use what we call total debt divided by total common equity. So, to be able to calculate it for Walmart, we can get the information about total common equity. So let us go back there to the balance sheet. Of the Walmart. So total debt. Let's say that we put this information here. Total debt. I'm gonna get this for Walmart for this 2020. So now you can, as a practice, try it for these 4 different companies or any other company of your choice. So at least I'm giving you the way to do it. Okay. Now total common equity. Total common equity. Okay, for Walmart, we can get that from the balance sheet here. Total common equity. Now look at equity here, common stock right here. 1 minute, just 1 minute. I might check something up. So I'm gonna share this. Okay, 1 minute. Let me share the screen. Put this here. Okay, total common equity. So you can see the common equity here, and then we can use it to calculate the debt to equity ratio. Debt equity ratio, total debt divided by total common equity. Okay, now let us do it. This sharing the screen is a little bit okay, good. Total equity, you can see right here, total common equity right here. So you can copy it and then paste it where we have the here, and then calculate the debt to equity ratio. So debt to equity ratio equals total debt divided by total common equity. And then you can now copy the formula to this side to get the answer we have and format it. Usually make it 2 decimal places at the much better than all this number of decimal places. So this will give us, it went down slightly in 2021, but it was 1.90 in 2021, slightly. Now, what does this mean for Walmart? Well, I will explain it. It means that for 2021, for the year 2021, 1.88, there was the debt to equity ratio of Walmart of 1.88, but for the 2021, it means that 1.88 cents of debt for each dollar of equity. So for each dollar of equity that Walmart has that year, it has $1.88 of debt, which means that if they say that Walmart has $1 million of equity, that means if it has $1 million of equity, that means it has $1,880,000 dollars of debt. So that's what's basically the way to interpret it. Now, if you look at for the other year, which is 2020, for each dollar of equity, it has $1.90 of debt. So if you have $1 million in equity, it has $1,900,000 of debt. That doesn't look that much good. So you have more debt than the equity. Now, sometimes it might if Walmart is doing a project, maybe expanding their operation in other countries, this might not be bad because they use debt to finance their operation. So with that, that kind of expansion can bring future profit and future value. Okay. So far, I hope you are getting it. Now, let's see what next debt management ratios to compute for Walmart. The next one will be time interest earned ratio. Now, this ratio measures the proportionate amount of income that can be used to cover the interest expenses. Of course, you know that the interest expense means interest that the company pays on their debts. So some analysts call it the solvency ratio because it measures a firm's ability to make interest and debt payments. So if you cannot pay the full amount of your debt, at least if you continue to make interest payments, that might keep your lenders, happy, and they'll leave you alone to do some project that will increase value. So for the time interest and end ratio, the formula is income before interest and taxes, which we call earning before interest and taxes, divided by interest expense. So that's TIE, earning before interest and taxes. That's EBIT. You can see right here, I wrote it right here, EBIT, divided by interest expenses. Okay. So now this ratio tells us if the company can make the payments, or if it's going to go bankrupt. Because if you cannot make payment, their investors, their lenders might be angry. They need their money, they might seize their assets. Yeah. So as with most expenses, if the company can't make the payment, it can go bankrupt and cease to exist. So that's why sometimes they call it the solvency ratio. So again, it's calculated using this formula, EBIT divided by interest expense. Now for McDonald's, for Walmart, let's calculate it for Walmart. Now I'll take you to the balance sheet. The income statement for Walmart. That's where we can get the information to calculate it. So you have time interest and ratio. I'm gonna put this 2021 and 2020. So you have time interest and ratio, time interest and actually time interest, time interest. Oh, I have to put the information first. EBIT, earning before interest and taxes, and interest expense. Yeah. Now I can put time interest and ratio. Interest and ratio. So and now do it. So the EBIT, earning before interest and taxes. Oh, I think we're in balance sheet. So I'm going to take you to income statement because I'll take you to income statement because that is where we can find the information we need to calculate this. So I'm going to copy this. Income statement for Walmart. So I'm going to put you there. Okay. Everything will be here. Good. Okay. Very good. Now, let's find the earning before interest and taxes, which is the EBIT. Okay. Now, it's right here, operating. Sometimes they call it the operating income. Some balance sheet, they put it, they report it as operating income. Otherwise, it can also be called earning before interest and taxes, or EBIT. So for since we have enough information here, we have from 2021, 2020 to 2029. Let us use all the data there. So I'm going to copy them here and then paste it. For the EBIT, why don't you do this? Okay, let's see. And I'm going to put it here. Say put 2019. Okay, now, and this is interest expense. The interest expense, you can see right here, interest expense net, interest net. So I'm going to use this. And then copy and paste it here. Okay. So now time interest and ratio. So we get equals earning before interest and taxes divided by interest expense. Now you can now press the enter key and then copy it to the end. And then of course you highlight it. Okay. Now I make it to the smart places. That's the convention. So it can be easily to interpret. Make it simple. It's always better to make it simple. Now, what does it imply for Walmart? Okay. See, it was 10.31 here in 2019. It went down. Then, went back up again. Now, what does this mean for Walmart, or what does it imply for somebody trying to invest in Walmart? First of all, for 2021, it's 10 point. I actually have it here to 10.3. See, which means that Walmart income in 2021, Walmart income is approximately 10 times greater than the annual interest expense. That means the money they have is 10 times greater than the amount they pay on interest on their debts. So they can more than cover their interest on the debts that year. For 2020, they have the company's income is approximately 8.5 times greater than the annual interest income. So if you are paying, let's say that the interest amount they pay to their lenders is 100 million. That means their income per year is 850 million. So you can cover that debt, see, and still have some change. Now, for year 2019, their income is 10 times greater than the annual, interest payment. So even though they have many a lot of significant amount of debt to finance their assets, they still have enough money to cover the debt and the interest. This makes Walmart, still a good company. Now, um, of course, you can extend this work to different companies. Like if you're an analyst, basically that is what analysts do every day. They do this kind of analysis for every company. That's how they pick companies that are, I mean, those of them that are doing value investing. I'm not talking about those that do technical analysis using charts and that tells you where the stock will be now and excuse me, next minute, which may change. So we can extend this, do it for many companies. Those companies that you want to put your money in and see how they're looking at, with respect to this variable. Now, how does these things, all these things that we so about Walmart, how does investors making use of this, how does this see Walmart? Okay, let me put it in a different form. How does this reflect in the value of Walmart, on the stock price of Walmart? So you can look at it because first of all, let's look at the debt ratio for Walmart. You can see that the debt ratio told us that the company, for their assets, looking at the balance sheet, you can see debt ratio only 65%, well, 65% of their assets are financed with debt. Now, then Target, only 29% are financed with debt. Tesla, only 25% are financed with debt. Okay. Now, McDonald's 25. So you can look at this. I want you to pay attention to these two companies that have less debt, that finance their operation with less debt. And then we can compare it with the value for Walmart that have higher debt, ratio. So you can just there you can, say for yourself what you think. So let's start with Walmart. I'll take it to Yahoo Finance. Okay, Walmart is WMT. Make sure you're seeing this. Yeah, make sure you're seeing this. WMT. I can see WMT. Okay, so stock price is $1.41 per share. So far this is still morning, so it might change eventually during the day. No, as you know, Walmart has more debt than Target. So let us see how Target looks. It's fair. Target Corporation. Okay, and see. Let me put it this way. Target Corporation. Target. Okay, I'm gonna put right here. You can see the stock value is more than Walmart, $227 per share. Approximately $227 per share. It has less debt. Now, next company, if you look at the next company we have here, it is McDonald's, which have so much debt, 98%, 0.9. I mean, it's like 8% of their assets are financed with debt. Let's see how much is paired. Now, it doesn't mean that tomorrow they will push the price down all the time. Sometimes if the company is doing some projects, it might, may impact the stock price. If shareholders or potential investors see the company as that is going to have more value, add more value in the future, irrespective of the debt level. So in this company, we have McDonald's, MCD, McDonald's Corporations, MCD. Okay, I think I have it. McDonald's Corporation, MCD. McDonald's. Yeah, I got it. Okay, it's still 248. See, even though they have high debt, probably the McDonald's is embarking on a lot of projects that for some reason investors believe that it added value. Now, remember McDonald's and Target are not in the same industry. So probably if you check the other company in that industry, you can now judge for yourself. Now, how about Tesla? Tesla is, you can see Tesla. Okay, here. I can see right here, $630 per share. Yeah, and I think it has the lowest debt. Actually, I'm surprised that it has the lowest debt ratio because Tesla have been doing a lot of projects, including going to the space. So it has the lowest debt ratio. Projects that involve going to the space. I think it's SpaceX they call it. Now, so far, I'm sure you are enjoying this. Let's see what else we have. Now, in our next lecture, we'll be talking about the profitability ratios, the ratio that tell us how well a firm is performing in terms of its ability to generate profit. So in our next lecture, we'll be doing that. I hope you enjoyed my lectures, today's lecture so far. And thank you for watching. And I will see you in my next lecture. Have a good day.